Welcome to the insurance regulation chapter. This chapter is relatively fast and it's very easy. This will be on every test, usually has around 30 questions out of this chapter. But you shouldn't have difficulty grasping. It's a lot of memorization and it's very easy stuff. Before we get started, I'd like to just talk about the structure of insurance regulation. Every state has a Department of Insurance. They have different names in each state. So like Texas is called TDI, the Texas Department of Insurance. In Maryland, it's known as the Maryland Insurance Administration. But insurance is regulated on a state level. And each state has somebody called the Commissioner of Insurance. The Commissioner of Insurance runs the Department of Insurance. Some states call the Commissioner a director or an executive, but the Commissioner of Insurance, also known as the director, runs the State Department of Insurance. The Commissioner is appointed by the governor, and really the Commissioner kind of is the figurehead of the department. The Commissioner doesn't have to know anything about selling insurance. They have to know the laws and the accounting for the insurance companies. They're really a smart person who deals with the money, the financials. If an insurance agent breaks the law, they have to hold hearings. But the Commissioner of Insurance, also known as the director, runs the Department of Insurance. Now, the Commissioner is also a part of something called the NAIC. Since every state has a commissioner, they all decided to form a private, non-governmental association known as the National Association of Insurance Commissioners. The National Association of Insurance Commissioners is the commissioners from every state making sure that they talk to each other and making sure that insurance is uniform across state lines. Meaning that if you buy homeowners insurance in Texas, it'll be very similar to homeowners insurance in Maryland or homeowners insurance in Florida or California. So they all talk typically 2 to 3 times a year, and they try to keep up to date with the insurance rules and make sure that everything's uniform across the state. Now that we know the structure, we can learn everything relatively quickly. In order to get an insurance license, you have to be age 18 years or older, and you have to pass a test. Once you pass the test, you'll have 12 months to apply for your license. Hopefully, you've already applied for your license before you've even taken the test. That'll save you some time. After you pass the test, you'll file your application, pay the required fees, which is $50 in the state of Texas. If the insurance commissioner decides to decline your license, the commissioner has to give you a detailed reason why they declined your license, and your license will be declined for 5 years. You can reapply after 5 years. If the commissioner ever denies a license, you can also go through the appeals process. And if you really want to, you can take it to the district court and go through the court systems to get that overturned. The only real people that get their licenses declined are people that have really bad felonies in their background. The type of license you're obtaining is a resident individual producer's license. You're a resident of this state, you're a person, and you're a producer. That's an insurance agent. You can get something called a temporary license. Temporary licenses are only good for 90 days, and you cannot sell insurance to your family. This is typically if 2 people were married and one died. This person could get a temporary license very quickly. That way they could take over the agency and get things up and running and back as quickly as possible. If you have a temporary license and you do not get your real license within those 90 days, you have to wait 6 months before applying for another temporary license. It's supposed to give you time so that you can get your real license in the event of that disaster. If you want to sell insurance in another state, you can get something called a non-resident license. You do not have to take a test to get a non-resident license. That's because of something called a reciprocal agreement. Essentially, if you're good enough to sell insurance in Texas, you're good enough to sell insurance in the other states. You only have to pay a fee and fill out an application in order to get your license in the other states. Different states have different fees. Your continuing education to maintain your real license is only required in this state. You don't have to do CE credits in every state, just the state that you're in. If your Texas license ever lapses, all of your other licenses will lapse as well. So make sure that you maintain your Texas license if you're selling in the other states. Non-resident licenses are very, very simple to do. If you need to get a non-resident license, you can go to this website, www.nipr.com. It might be .org, but I think it's .com. And it's the National Insurance Producers Registry.com. So if you want to sell insurance in another state, you just get a non-resident license. You do not have to take a test, and you only have to do CE credits within this state. The Commissioner of Insurance can inspect your books and records once every 5 years. They only inspect you if you got caught doing something wrong. As a producer, you will act in a fiduciary capacity with your customers and the insurance companies. Fiduciary means financial. Fiduciary is a money handling trust capacity. As an agent, you cannot commingle funds. What that means is you can't take the customer's money and mix it with your money. Any money that's supposed to go to the insurance company has to go directly to the insurance company promptly. In property and casualty, it's very common to have an escrow account, which is a secondary account that you put the insurance company's money in, then you write checks to the insurance company. So as an agent, you act in a fiduciary capacity to the insurance companies and the customers. As an agent, you can advertise and share commission with other agents as long as they have the exact same license. You cannot give commission to people who are unlicensed. It's very common in the insurance world to make friends with other agents and to refer business to each other if it's something you don't want to write. But you do have to have the exact same license. If the insurance company uses testimonials from people and they pay for them, the insurance companies must state that that is a paid testimonial, and every advertisement of the insurance company has to have the true name of the corporation. So that's like in that fine print, it'll say like, this is the real name of our insurance company. As an agent, you can only have 75% of controlled business. Controlled business is insuring only yourself, your family, or your businesses. 25% of your book must be from the public, of random people, not family. If you only insure yourself or your stuff, you can lose your license due to controlled business. Controlled business is establishing an agency only to insure your businesses. As a regular agent, you don't have to worry about this. It's mainly for like really big companies getting a license just to insure themselves. If you get caught doing something wrong, or if you move, or if you get a felony conviction, you must notify the commissioner within 30 days. Even if you move down the street, or even if you move to a different office, you have to notify the commissioner within 30 days and update your address or your convictions or any regulatory actions against you. If you get caught doing something wrong, the commissioner will send you a cease and desist order. That means you have to stop selling insurance immediately. Then you will have 30 days to request a hearing from the commissioner and say, hey, I didn't do anything wrong. The commissioner then has 10 days to schedule that hearing after you requested it, unless you both agree that a better day would work. If you get caught doing something wrong, you can get 10 years for a felony, 18 months for a misdemeanor, and your license can be revoked for 5 years. But again, you can appeal that if you disagree. Your license will be good for 2 years. It'll renew every 2 years on your birthday. In order to renew your license, you do not have to take another test, but you do have to take continuing education credits. In Texas, you need 24 hours of CE credits every 2 years. Only 50% of your CE can be done online. The other continuing education credits have to be done in classroom. You will need 2 hours of ethics every 2 years. And if you sell flood insurance, you'll need 3 hours of flood insurance. These also apply if you have a life and health license as well. So you don't have to get 24 hours for each license, just 24 total for your insurance license. After you do your CE credits, you must maintain a record for 4 years. We provide continuing education credits. So all you have to do is go to our main website, tsinational.com, and select your state, and you can get your CE credits done very simply through us. The insurance commissioner's job is to conduct investigations and examine insurance company. The insurance commissioner counsels the governor on all state laws. The insurance commissioner can do fines, can suspend or revoke your license, but if the commissioner decides to do anything against you, it has to have an open hearing. Whether or not you show up is a different story. The commissioner is appointed by the governor for a term of 2 years, and the commissioner has to have 5 years of relevant experience in accounting, law, or business. Becoming an insurance agent will not allow you to become the commissioner. They don't sell insurance, they just regulate insurance and enforce laws. All forms in Texas have to be in English or have an English translation. Insurance companies cannot use excessive, inadequate, or discriminatory rates. All insurance companies file their annual financial report with the commissioner on June 30th. The financial report is usually how many customers do you have, how many claims do you have, how much money do you have on hand. The insurance commissioner tells the insurance companies how much cash reserves they have to have. So like if you're a really big insurance company and you only have $2 million on hand this year, the insurance commissioner might tell you to get more money. The insurance commissioner cannot activate an insurance company's claims reserves. So like if the insurance commissioner says you have to have $20 million in order to be an insurance company, they can't spend your money. They can just tell you how much to have. This is a weird question on your test. It says, which of the following is not a duty of the insurance commissioner? They can set claims reserve limits, but they cannot activate claims reserve limits. Activate is the key word on this test question. In the state of Texas, insurance companies become admitted, also known as authorized, if they can transact business in Texas. Non-admitted, also known as unauthorized companies, are not allowed to do business in Texas. That's not true, though. We'll learn why in a second. Non-admitted companies are also known as surplus lines. Let me explain what this is. You're going to use this in property and casualty. So in Texas, we have the TDI, Texas Department of Insurance, and we have the commissioner over top of that. Pretty much every insurance company you've ever heard of is known as admitted. That means that they follow all of the rules of the state, and the state of Texas gives them a certificate of authority that allows the insurance company to do business in Texas. That means that they have their claims reserves, that means that they have a good reputation and everything's fine. Non-admitted companies, also known as unauthorized, also known as surplus lines, do not have a certificate of authority. Non-admitted companies do not typically have to follow all of the regulation. Non-admitted companies, known as surplus lines, are for higher risk business. It is regulated, just not as much. If you've ever heard of Lloyd's or Lloyd's of London, that is a surplus lines company. In Texas, we call it the Texas Lloyd's. They insure almost anything. Surplus lines companies are not illegal. It's just that you have to get declined by 2 insurance companies here before you can go here. So for example, I've insured some clinical trials for cancer. The regular admitted authorized companies don't want to do clinical trial insurance. It's too high risk. So what you do is you quote it here first, they get declined twice, then you can go to the surplus lines company, who, say Lloyd's of London, Texas Lloyd's, will insure that at a much higher premium. The downside of the surplus lines companies are that they are not backed by the Insurance Guarantee Fund. And they are also not regulated as much by the Texas Department of Insurance. If a surplus lines company goes bankrupt, they will not receive any money from the guarantee fund that protects the customers. If you have a complaint about a surplus lines company and you go to the Texas Department of Insurance, TDI will say they're not authorized to do business in Texas, so we can't help you. You're kind of on your own when you have insurance through a surplus lines company. As an agent, if you represent a surplus lines company, you can also be liable for the actions of the insurance company. Meaning that if this company steals the customer's money, the customer will sue you and the surplus lines company for putting them there in that position. Surplus lines insurance is not a bad thing. It's just a very high-risk industry for properties that can't get insurance elsewhere or businesses that can't get insurance elsewhere. If you write business insurance, you'll be doing a lot of work with the surplus lines companies. So in your test, an insurance company that does not have a certificate of authority is known as non-admitted. Non-admitted companies are known as surplus lines. In Texas, Texas Lloyd's is a surplus lines company. Surplus lines companies are legal. They're just for higher risk businesses. If you get declined twice from the authorized company, then you can go to an unauthorized company. As an agent, if you represent a surplus lines company, you and the surplus lines company are on the hook. The Texas Department of Insurance will not help with the complaints of the surplus lines company. Admitted companies have the backing of TDI and are protected by the guarantee fund. Let's quickly talk about what the guarantee fund is. The guarantee fund protects admitted companies in the event they become insolvent. The guarantee fund actually protects the client, the customer, because what it does is it will pay claims and refund premiums if the admitted company goes bankrupt. That's what the word insolvent means. The guarantee fund is kind of like the FDIC for banks, but the guarantee fund is a private association. It's a nonprofit that the insurance companies all pay into. And if one of them goes bankrupt, then the guarantee fund can pay claims and return money back to the customers. It's not a state-funded fund. The insurance companies pay for the guarantee fund themselves. Surplus lines companies, since they are not admitted, do not have the protection of the guarantee fund in there. So you really kind of have to watch yourself if you're putting businesses with surplus lines, because not only are the premiums higher, but the customer doesn't have as much protection as the admitted companies. But if you end up writing a lot of business insurance, then you will put a lot of business through surplus lines companies. So insurance companies are admitted if they have a certificate of authority. Insurance companies are non-admitted if they're in surplus lines. If a surplus lines company writes a policy in Texas, then no longer sells insurance in Texas. Let's say they move out of the state, they still have to pay any claims on the stuff that they did. The courts will come after them if they start denying claims. These next words are unfair trade practices. Unfair trade practices are actions that the agent can do, and these are illegal. Illegal is any act that's not legal. That's like lying or misrepresenting policy provisions. As an agent, defamation is also illegal. Defamation is committed through slander and libel. Slander is oral. Libel is written. It is illegal for you as an agent to speak poorly about an insurance company's financial position. You can never say, hey, that insurance company's going bankrupt. That is illegal. That is defamation. That's an unfair trade practice. Rebating is also illegal. Rebating is sharing commission with a customer or an unlicensed person. So like if you're sell insurance to your sister and your sister says, hey, give me some of the money you made. You can say, no, that's rebating. That's illegal. You cannot give an unlicensed person any commission. You cannot pay for their premiums for them. That is your money. You do not have to tell people how much money you make. If they ask for some, say, no, go get a license. Send them here. Twisting is also an unfair trade practice. Twisting is when you lie during policy replacement. If you have two auto policies and they're exactly the same, but you make this one sound like it's magical, that's twisting. Twisting is twisting the truth, trying to get somebody to buy your policy when it's the exact same thing as what they had. Blank forms is also an unfair trade practice. Unfair trade practices are illegal. We cannot just have people sign at the bottom and fill it out later. That's a blank form. We have to fill out the actual application with the customer. Boycotting, inducement, coercion, and intimidation are all bad. If it sounds bad, it's likely illegal. Boycotting is like when you represent an insurance company and it's the best for the customer, but you decide not to sell it. That's boycotting. Inducement is like giving people money to buy from you. You cannot do that. That's also like rebating. Coercion is when you scare people into buying from you, or you tell them that it's only good for one day, or the quote is only good for tonight. Intimidation is also like scaring people into buying from you. You cannot scare people or lie. Those are all unfair trade practices. As an agent, if you represent a participating company, which means mutual, you cannot tell them that dividends are guaranteed. Dividends paid by mutual insurance companies are not guaranteed. They're based on the performance of a company. So you cannot tell people that dividends or anything will be paid. You can say it might be paid. As an agent, if you sell credit insurance and you make them buy a policy from you, that's also illegal, and that's known as coercion. Credit insurance is not really a property and casualty term. It's used on this test, but it's not really property and casualty. It's life and health insurance, similar to gap insurance. If you sell gap insurance, you can't tell them they have to buy it from you. They can buy this stuff from anywhere they want. On your test, if it sounds like it's illegal, it's likely illegal. As an agent, when you represent an insurance company, you become appointed with that insurance company. You can have multiple appointments. So you can represent like Safeco, Travelers, Hartford. If you want to represent multiple insurance companies, you would just seek an appointment with that company. If the insurance company no longer wants to do business with you, they can terminate your appointment. If the insurance company terminates your contract, they must notify the Department of Insurance immediately. There's only two real reasons you get terminated in the insurance world. Either you lied and did some fraud, or you didn't produce enough. If you didn't produce enough, you didn't make enough money, they don't really have to notify the Texas Department of Insurance. But if you lied, they have to tell the Texas Department of Insurance, and they'll do an inquiry, and that's when the whole fraud thing comes at you. If you don't work at the company anymore, your policies still remain in force. Just because you don't work there anymore, it doesn't hurt the customer. In Texas, we have something called a Managing General Agent's License. An MGA cannot sell insurance. They just recruit, train, and supervise agents. It's kind of like a pyramid. Every policy that an agent sells, the MGA will get a percentage off that. MGAs do have to take a test if they want to become a managing general agent, but they can't sell insurance. They just train agents. A lot of insurance companies have MGAs. They're responsible for training you, and every time you sell a policy, the MGA will earn commission. In Texas, we also have something called an adjuster. Adjusters handle claims. If a customer lawyers up, the adjuster cannot talk to them. If the customer gets their own adjuster, the adjusters have to talk to each other. Adjusters are not lawyers. They handle claims for the insurance companies. If you ever have a really, really big claim, you might want to get a lawyer. That way you don't get talked into doing something you didn't want to do. Now, before we finish this chapter, there's just a few more things that we have to learn. A domestic insurance company is based out of this state. So like I'm in Texas, so an insurance company that is incorporated in Texas is known as a domestic insurance company. That would be like Germania, Farm Bureau, USAA. Those are all domestic insurance companies because they're based out of Texas. A foreign insurance company is based out of another state. So like State Farm and Allstate are based out of Illinois. So they are domestic to Illinois, but foreign to Texas. An alien insurance company is based out of another country. That would be like Lloyd's of London, which is London. So domestic is based out of the state that you're currently in. Foreign is any other state or United States subsidiary, like Guam, Puerto Rico, Micronesia, the U.S. Virgin Islands. Alien is another country. That's like France, Britain, China. The next things we have are stock, mutual, and fraternal insurance companies. Stock insurance companies are owned by stockholders. Mutual insurance companies are owned by policyholders. So you might have heard of Liberty Mutual or Mutual of Omaha. If you buy insurance from a mutual insurance company, the policyholder actually owns the company. Every policy you buy is like owning a percentage of the company. Then at the end of the year, the policyholders elect a board of trustees to run the company. Mutual companies are also known as participating because the policyholders participate in the company. They elect the board of trustees, and they also receive dividends if the insurance company has a good year. So you might have heard of the safe driving discount. If you don't have an accident for a year, they'll lower your premiums. That would be an example of a dividend. Mutual companies pay dividends to policyholders because they're the owner of the company. Stock companies pay dividends to stockholders because they own the company. Stock companies have like CEOs and a board of directors that run the company. Mutual, also known as participating, has a board of trustees that the policyholders elect. As an agent, if you represent this mutual company, you cannot tell the policyholders that dividends will be paid or that dividends are guaranteed, because dividends are based off the performance of the company. It's usually a refund check or a discount in the policy. Fraternal insurance companies only sell insurance to members of their organization. So like USAA, for example, used to only sell insurance to military members and their families. That would be an example of a fraternal. You have to be a member of the organization in order to buy insurance from them. These are going to be on every test. They're relatively easy. You can have a domestic authorized company. That's an insurance company based out of Texas that does business in Texas. You can have a domestic unauthorized company. That's an insurance company based out of Texas but doesn't have a certificate of authority. You can have a foreign authorized, foreign non-authorized, alien admitted, alien non-admitted. Domestic, foreign, and alien are about where their headquarters are at, where they're incorporated. Authorized and unauthorized is whether or not they're approved or not in the state. And then stock, mutual, and fraternal are the structure of the company. Stock companies are owned by stockholders. Mutual companies are owned by policyholders. Fraternal organizations have members-only policies. The insurance regulation portion of your test is relatively simple. As long as you take the practice tests, you'll memorize all of these things very quickly. This is the relatively easy portion of your test. But anyway, thank you for studying, and good luck on your practice tests.